Good morning.
All right. Well, welcome to a snowy day in the upper Midwest. Great to have all of you joining in for the Launch Minnesota Friday Forum today. We've got I think a great topic today that's always near and dear to the hearts of entrepreneurs. It's dealing with how to engage with venture capital, particularly early stage venture capital. We've got a couple of good panelists here we'd like to introduce you to. We've got Garrett and Henry. Garrett is with the Idea Fund. I'll turn it over to him in just a moment to give a little overview of the Idea Fund, what their priorities are, what they're looking to do here. And then we've got Henry from Expert Dojo dialing in. Henry is going to give us a little bit of an overview there as well. And then we'll go into kind of a handful of questions, and then we'll turn it over to the team. So Garrett, if you wouldn't mind.
Yeah, for sure. Thanks for having me, Rob. Nice to meet everyone. I'm Garrett Lauderdale, Vice President at Idea Fund. And to get it out of the way right off the bat, I am from Wisconsin and I am a Packer fan. So if anyone needs to boo, it's okay. I understand. But I do want to let you know, for the last 10 years, I have lived in Minnesota, and I currently live in Minnesota, including in Minneapolis, Maple Grove, Bloomington, and now I am in La Crescent in the southeast part of the state. So hopefully that eases the tension a little bit there.
Garrett, you are clearly not a sales guy, are you?
No, new to it. Yeah. Idea Fund. So we're an early stage VC. We're located in La Crosse, Wisconsin, and we're about 18 months into our second fund. So I'll give you a quick history. First fund launched in 2017. That was a Wisconsin-only fund, $13 million, 11 portfolio companies, one exit out of the 11 so far, and very excited about a number of companies in that portfolio. I work with my partner and colleague, John Horn, who raised capital for our second fund. We had the initial close in the fall of 22 on $20 million. And then that's when I joined the fund to support this fund too. We've continued to fundraise and add capital, and we're having our final close this spring. So we added a nice little bit to it as well. And, we really have a geographic focus on the upper Midwest, which is why I'm excited to talk to all of you. Our three focus states are Wisconsin, Minnesota, and Iowa. That's where we're proactively spending time building network, deal sourcing, and frankly, where we want to invest. So the majority of our efforts are on those three states. And we're investing in technology companies, meaning primarily software. We're industry agnostic, really looking for diversification across the end markets of our investments. Our fund is set up 50-50, meaning half the capital is for initial investments, and then we reserve half our capital for follow-on investments, meaning we plan to go multiple rounds with our portfolio companies. Fund one was 11 portfolio companies. Fund two, we're projecting about 20 companies. And for us, a good check size on the initial investment is 500,000 to $1 million. And that's a loose range. It could be a little higher, it could be a little lower. It's not uncommon that we would be the first institutional capital into a startup. That's a common spot for us. We work with a lot of first-time founders. I would say from a traction standpoint, anywhere from pre-revenue, pre-product, so $0 in revenue to say a couple $100,000 of ARR. That's a common entry point for us. We can also go a little later than that as well. And that's a little on Idea Fund. We're off to a good start. So out of Fund two, we started deploying last year, closed 4 new investments, and then we have 2 more under signed term sheets right now that we're wrapping up. So knock on wood, we should have 6 in here. Good start, but a long ways to go to 20. And we are relatively newer to the Minnesota ecosystem, startup and VC ecosystem, really kind of starting last year. So always looking for ways to be more engaged and meet more folks in Minnesota. And we did close our first Minnesota-based startup last year. So we're excited about that, a company called Lumberjack Technologies.
That's great. Hey, Garrett, thank you so much. we'll get into quite a bit more as we go. But Henry, maybe you could give us an introduction and a little overview on Expert Dojo.
Thank you, Rob. Thanks for having me. Hello, everyone. It's a pleasure to be here. So I'm a venture partner at Expert Dojo, and we're based out of Santa Monica, California. We invest in pre-Series A startups globally. We run a global fund, and we've done a little bit of 280 investments to date globally. And we are targeting even more investments, up to 100 investments this year as well, right? And we're more like a place you come to when we're done with your initial seed stage accelerator program. You come to us, and the reason why startups or companies come to us is because of our focus on growth. Our primary objective is to be able to get more early stage companies to Series A. So that's how we structured. We're more like built to be a pipeline for Series A investors. So we have a bunch of them as partners that we work with, constantly looking out for the next thing coming out of Expert Dojo. So what we do majorly is to focus on two core things. First is our go-to-market. We ensure that we help our portfolio companies ensure that they have a well-refined go-to-marketing strategy and messaging that resonates with the target audience. The objective here is to be able to maximize the cost of customer acquisition and essentially, help our portfolio companies acquire more users for less. That's what we aim for in that direction. And the next thing is on sales. We've realized, investing in a lot of companies, we've realized that because of the technical background of some of these founders, very few have experience in sales and marketing. So we use that opportunity to, make, as part of the core offering in our program, we help our portfolio companies set up strong sales systems that allows them to, constantly be outreaching to as many potential customers as possible so as to guarantee their revenue targets for the year. So these are the two core things we focus on. We also, of course, help with expansion across the US, also expansion across Europe, Latin America, and Africa, depending on where the next big thing is, given where industry is at. So we're pretty much global. We have teams across these regions to facilitate and support our portfolio companies across these regions. And we've been investing. So just so I create a little bit of background here, before we started investing a little bit of 3 to 4 years ago now, we used to be a consultancy focused on helping small businesses really crack growth, right? So at the core of the team is growth hackers, sales experts that, all we do is just focus on growth. So what we're known for in LA and Santa Monica is just the growth team. So we're more like your outsourced growth team that you can work with to ensure that you're on track to really hit the right metrics and KPIs required for you to raise a Series A. So I think I'll just stop there for now, but we're happy to. We are constantly investing. Every week, we're actually investing every week. Maybe I will speak a little bit more on this check size. So we do an initial investment of $50,000 for 3.5% of the business initially, right? And this is more like a skin in the game money for us. The actual investment comes as a follow-on investment of $1 million for 10% of the business. So that's how we structured. We invest twice. First $50,000 initial check, and then $1 million as a follow-on investment.
That's great. Great overview, Henry. Thank you so much, and Garrett, you as well. So why don't we dive into a little bit of Q&A? I've got a few questions I'd like to kind of start off with, and then really love to hear from the panel group as well. So and maybe I'll throw this to Garrett first, and Henry, you follow on if you don't mind. Really competitive market if you're a founder looking to get funding. What counsel could you give this group in terms of the best ways to differentiate yourselves as a startup?
Yeah, you're right about that. I would say a couple of things. First, from kind of a process standpoint, I think on the founder side, you really have to be prepared to run your investment process like a sales process. Like, you should have your VCs set up in a CRM, even if that's an Excel spreadsheet. You should have a sales funnel. You should have a follow-up cadence. You should have, all your materials ready to go that you can send out in advance. You should have a data room ready to go, have all kind of the legal aspects that you need to have set up prior to, taking on external investment in place. Like, being a C corp compared to an LLC. So just I would say one, being prepared to run this as a process, knowing that there's going to be a lot of no's, but to get to a yes, you got to talk to a lot of VCs, similar to a sales funnel. And then two, I would just say preparedness of having as much as you can ready to go right out of the gate, data room, decks, financial model, having a good sense of your capital plan, not just this round, but moving forward. One thing we're always looking at is the capital plan and the pro forma and financial projections. One, to this, not only to the sense that they're thought out and in place, but also how well they sync up together and do they pair well and make sense.
That's great. Appreciate that, Garrett.
Yeah.
Henry.
Yeah, I think I'll just take over from the preparedness standpoint. I think it's very key because I would say fundraising is more. It's neither an art nor a science. Is a combination. Is a middle ground between these two things, basically, right? And as founders, I think we need to always, especially when it comes to fundraising, planning that out. Just as Garrett also mentioned, not just your current round, subsequent rounds coming up. You need to have like a wider overview of what the funding requirements would be like, for you to get your company to a place where it should go in terms of growth, right? And I think it boils down to finding that sweet spot between, burn rate and runway, right? You don't want to go out there in the market, especially in a market like we're in right now, when you are cash crunch, like you don't have enough runway to get you, to the next quarter or so, right? You need to be approaching fundraising from a place of strength, and approaching investors and appearing needy isn't going to do you any good in this kind of market, right? So it's that balance, that allows you to ensure that you have enough runway to get you going while you're having conversations on investments, but at the same time, your burn rate is also controlled well enough to allow for take, for example, the kind of markets we're in right now, where it's a lot more harder to access capital than it used to be before. So you have enough burn rate, well-controlled burn rate, that can also give you extended runway to allow you to keep doing business while things, change in the overall macroeconomic, outlook, right? So also, I think it's just finding that balance, like I said, and understanding that funding as well is not for survival, right? It's for growth. Like, VCs don't want to hear when you're talking about you need cash injection to extend your runway. And when they look at the plans and the milestones in place, there's no growth factor in there. It's just about maintaining status quo, ensuring that everybody gets paid. Like, you're not going to attract capital with that kind of mindset. So it's important for us to, approach fundraising from a place of strength, ensuring that, okay, you're coming to the market to seek for more capital to fuel your growth, and you have proof in terms of traction of what you've been able to do so far, how much more you're growing, and you need XYZ amount of money to infuse into the business in order to get XYZ more growth in place, right? So that's the kind of dynamic you need to find when you're out there fundraising for investors.
So Henry, building off that, so Garrett talked a little bit about kind of running it like a sales funnel or a sales process, and then as you brought in the concept of burn rate and making sure you're not kind of desperate for funding. How would you counsel a startup to think about, like, when is the right time to really be making that effort? Is there a number of quarters of cash on hand, or like how would you think through that?
Yeah, so I mean, one other thing to take note on that as well is, so you don't want to come approaching a VC and you have like 24 months runway already and you're looking to fundraise again. Like, the question would be, why do you need the money, right? So like you said, there has to be a balance. And I think anywhere from 6 to 12 months, and this is dependent on the nature of the business anyways, but give or take on average, you should have 6 to 8 months runway, with you. I would say having a runway of 6 to 8 months should be an indicator for you to, kickstart your fundraising journey. So you don't start fundraising when you need the money. Fundraising, and it's important to also understand to fundraise when you are coming from a place of strength. So take, for example, you've managed to be growing 30% month-on-month growth, and you have a runway of 6 to 8 months or even more than that. I think that would be a perfect timing for you to start the conversation on fundraising, because these things take time as well, right? So you need to be approaching, especially that first impression that, a strong traction, healthy runway gives you, it's important when you're approaching VCs for the first time, right? And so I think starting those conversations early on, even before the need for it comes, it's key. And you can't even do that just like Garrett said, if you've not figured out, okay, you're raising a seed round now, I'm going to need X, Y, Z amount for my Series A. I'm going to need beyond Series A, and for my Series B, I'm going to need X, Y, Z. You need to think that far, right? So I see this happen a lot with founders when we engage with them in conversations like this. They don't think beyond their current funding needs, and that's a huge problem, and also a red flag for VCs, right? So if you have a wide overview of what the funding requirements would be for the business, and then it's a question of having your dashboard. So every founder your primary dashboard is your metrics, showing you the cash flow, metrics of everything you're tracking. That should be your primary dashboard, and you're looking at that constantly. And if you get into a point where you're seeing you have healthy growth, the market is just responding very well to your product. You're growing month on month, quarter on quarter, depending on how you're calculating, you're measuring the metric, and you have some healthy runway. I think it's a good time for you to go out there, start the conversation with VCs, and then see how that way. If you plan things like this, it allows you to approach fundraising from you're not being pressured. You're not coming from that. We get turned off when I have founders telling me, hey, we need to do this. We need to close this client that will bring in X amount in revenue for us, but we need this capital to be able to unlock that. I don't know what to believe here. It's a red flag for me. It shows you're not planning things very well, right? So, I'll just leave it at that. But yeah, it's important to keep things in balance and to ensure that you're constantly on the lookout for your metrics and seeing how far they can take you.
That's great. Hey, thank you, Henry. Henry kind of alluded to one significant problem that VCs might see from a founder or in a founder, which is not managing that burn and crash chart effectively. So going over to you, Garrett, anything you'd add on that point? And then what other major pitfalls do you see in founders?
Yeah, and I agree with Henry. I think if you think about a 6 to 9 month kind of time frame, that's probably a really good framework to work off of, knowing that it's going to take time to work through the process and talk to a lot of different VCs and investment committees, decision making, and there's a number of steps to it before you can actually get a check in hand. So yeah, be cognizant of that. And yeah, if you need the money now or next month, you're a little late, and so you got to be in front of it. And as I'm sure everyone knows, fundraising is one of the many hats that a startup founder or CEO needs to wear, and it kind of has to constantly be on. Meaning, there's times where you'll be actively fundraising and running a process to raise money, but even say you raise money, the relationship building with venture capital doesn't stop. And you need to start laying the groundwork right away for your next investment round. And that's in getting introductions to firms that are going to be a good fit for that next round, getting them on your investor updates monthly so that they can start to track your progress. And so by the time you go out to raise, hopefully you have some warm leads and warm conversations set up. So I think that's a good practice to follow. And I would say on the pitfall side, one of the things that I think about is there's a lot of VCs out there, right? I don't even know how many are in the US, a bunch, that 4,000, I don't know, a lot. You could get capital from a lot of different places, but similar to, when you're selling to your customers, you're not just calling random people if you're saying, hey, do you want to buy this thing? It's important to spend your time wisely. And so I always think about the fit between investor and startup, and making sure that that's there. Otherwise, it's just not a good use of your time. And I will tell you, our first step in our investment process is just our initial screen, really high level. We invest in the upper Midwest. We're doing pre-seed and seed rounds. We're looking to do $500K to $1 million check. And I'll get I'll get founders and I'll get decks, submitted on our website and from all over. So if you're in Boston looking to raise a $4 million series A or B, why are you sending this to me? It's not a fit. So I think there's research that you can do ahead of time to make sure that you're focusing that energy accordingly, because obviously you have a lot of different hats to wear and things to do. So I would say just that could be a pitfall of not kind of targeting your VCs. And then another thing I would say is, it's important to, even if you feel like the conversation is going well with one particular VC, you're getting multiple meetings, you're moving through the process, don't stop other conversations and don't stop starting other conversations. You could get to the finish line with a VC, through investment committee. It's kind of a go or no go decision, and it might be a no. Like, don't put your eggs in one basket. Keep multiple conversations moving. I think that would be one thing that I've seen where some founders can get tripped up to.
It's not over until it's over, right? Until you.
It's not over till it's over. Yeah.
Henry, are there any other things that you've seen in your experience that are common missteps that founders make?
Yeah, there's a couple, and this also varies, but I like to speak especially to the current market reality, the stuff out there right now. And but what I see founders a lot, with unclear business models, for example, right? And that's also a red flag for us. Sometimes it's also as a result of the founders not being prepared enough to articulate what exactly the business offering is. And so I think it's something that founders need to pay attention to, being clearly articulate how you generate revenue, who your target customer is, and what competitive advantage you have out there that gives you an edge in the market, right? So it's important for VCs to get this from the get-go, right? So once that is established, I think the other pitfall I see a lot of founders fall into is also the problem of unrealistic valuation, right? This is my philosophy. I mean, I could be wrong, but this is what I think when it comes to these things. I feel valuations are just, they're just numbers you throw out there and, claim this is what you want, and you're trying to convince the other person on the table to agree to that valuation, and that's what you're worth. But I think in the VC thing, I think that really begins to become to matter in VC once you get to the Series A stage, right? I think anything you're doing within the pre-seed and seed stage should be strategic to a point where it's about raising enough capital to help you get to the next strategic milestone, and not just trying to haggle for valuations. I mean, look at what happened couple of years back when cash was all over the place. I mean, lots of companies that are raised at very high valuation, they're struggling right now to even raise another valuation because they can't catch up with the multiple that have already raised from. So I would say it's a zero-sum game to start playing the valuation game from the early stages. I think your focus should be on dilution. Focus on dilution as opposed to focusing on valuation at the very early stages, right? The real deal starts from Series A. And for me, I think until you raise your Series A, could wake up dead in India as a startup, right? So that is one thing I like to touch on, the unrealistic valuations. That can really, derail negotiations and conversations with VCs, right? And the last thing I think I would like to touch on is on lack of traction and also proof of concept. There's a lot of founders out there that, they go out to fundraise very earlier, right? I mean, founders also need to understand how VCs work. VCs are also, accountable to someone. So they call them LPs, limited partners. They give us money to invest on their behalf, and we're guaranteeing them, some sort of returns after a period of time. So we're looking to deploy capital into startups and businesses that have shown the potential. First of all, have proven that what they're building is needed by the market, and the market is willing to pay for that. And then there is, future growth in place as well. These are the kind of deals we're looking for, right? And it's also a red flag when you come right off the bat with just an idea without any form of skin in the game by, okay, this is what you've been able to do. I mean, I advise founders a lot if you can bootstrap, please try and do that. It teaches you a lot of things. It helps you understand the business a little even more better, but more importantly, gives you a lot of credibility when you're having those initial conversations with VCs, right? It's very important. And I think it would be a good way for you to know if it's worth doing this or not, right? And there is this thing I also like to talk to founders about. I mean, have two strategies. One is a bootstrap type strategy. The other is what you can do when you have funding. That way, you're not waiting for. I'm seeing a lot of founders. We are targeting XYZ amount in revenue for 2024, but we can't do that unless we have funding, and they are stuck, right? Why that is a good thing. Have a strategy that also allows you to keep growing with what you have. So it's about what can I do with what I have? How do I maximize this and use it to? The growth might not be so much, but at least there's some form of growth. So when you're speaking to VCs, they're seeing clearly what you're doing with the little you have. There's growth. It might not be very impressive, but there's growth. And then think of what would happen when you give me the XYZ amount of money I'm asking for. I mean, I could do more than that. So, I mean, it's that balance, and I think I'll just stop on this thing.
Henry, that's great stuff, though. I love the dilution versus value focus piece, as well as traction. We'll come back to traction in a bit. There's a question from Mike in the chat about what does your application to investment ratio look like? Maybe Henry, you could take a quick stab at that. How many deals do you look at before you actually make one?
Yeah, that's quite interesting. So typically on a month, so I would say we're a bit different from other VCs. Like we outreach to startups. Like we do constant outreach into startups. Like we don't sit back and wait for applications to come in. We are out there, so we treat this like a sales thing. So I mean, like we focus on sales as well. It's a huge part of what we do. So it makes sense for us to also apply some sort of that knowledge and learnings into our own process. So every month, myself alone, I see anywhere from 200 to 250 deals every month. This is just from my end alone. And this includes the entire Latin emerging markets region, right? So about 200 to 250 deals every month. And in a year, we could see thousands, right? We see thousands of deals at Espada Dojo every year. Like we have lots of them on our CRM today, right? And I would say we do less than 1%. I mean, we invest in less than 1% of these deals. And this is also typical for any other VC out there, right? So you should understand, I think this should also give our founders some insight as to how tough it is, to come to a close with these conversations when it comes to investment. And this also should also keep you on your toes to really understand that, hey, I need to have two strategies. I could get this or not. So that way you're not forced to stop because you're unable to attract funding, but it might take you longer time to, and I've seen this in the emerging markets a lot, maybe because they don't have access to capital as much as, folks in the North American markets would have typically. They have that in mind, right? So we could get this money or we couldn't. So what can we do? So it forces them to innovate, come up with, innovative ways of, going to market, come up with innovative products that allows them to, move across different verticals and stuff like that. So there's a lot of competition out there, a lot of very good companies out there, just to give you an understanding too. So sometimes we might be speaking with this company, I would think, hey, these guys are so strong, these guys are so good. By the time we're getting towards the end of the due diligence phase, we have another startup that comes in and just makes whatever we think we've seen like nothing, right? And this is what you're in competition with, for founders, and people are really working out there. So find whatever gives you a competitive advantage when it comes to these conversations on fundraising, and try to put your best foot forward at every time.
That's great. Hey, Garrett, how do you guys look at that funnel?
Yeah, I'd say percentage-wise, we're pretty close with Henry. Lower volume with our strategy, but if we look at Fund 2 from the end of 2022 through 2023, we reviewed almost 400 deals, and so that's kind of getting into layer one, like see more companies out there, but we have an initial conversation or review materials, pitch deck that we get, 400. And then that translated down to writing 6 term sheets, with 4 of them closed and 2 still under the process. So that's about a 1.5%, yield so far in fund two, and we anticipate we kind of mapped out 2% or below. So we're kind of tracking right towards that. And it's, so yeah, you have to have, on the VC side, you have to have a wide funnel as well, just like you do on the founder side. And I would say for us, it's probably a good 80% plus gets kind of gets kicked out of the funnel within our first review process. So it's kind of some of the high level stuff. And then, it's 80-20 rule. We're spending our time and energy going deeper, having more conversations, doing more research on the 20% or less that has a potential fit with our overall fund strategy.
That's great. Appreciate that. Next question I wanted to ask you both is, recognizing the number of deals you look at, how competitive it is, how few you actually invest in. We talked a little bit about how entrepreneurs might differentiate themselves. What do you look for in a team and traction as two separate but related issues, Garrett, when you're evaluating deals?
Mm-hmm. Yeah, so I'll start with founder and team. This one is interesting because there's not one kind of like success metric with it. One thing I'm always thinking about when I'm first speaking with a founder is kind of like founder problem fit. Like why this founder for this problem or this solution? And we kind of see a spectrum. I think about a spectrum with two sides of it. One, there's like industry knowledge. So is this person coming out of industry with experience and kind of an interesting take on a problem that they saw within industry, and now they're breaking out to solve it? And then you kind of balance that with startup experience, previous startup experience, which the majority of founders we speak with are first time founders, and most haven't worked at a startup before. But there's interesting, of course, lessons and experiences that you have if you have spent time at a startup before. So you kind of are looking at these two different background criteria just to get a gauge of from an experiential standpoint. And then for us with the founding team, especially with the CEO, I would say we kind of have 5 main buckets of criteria that we're looking at when we're going through doing due diligence on a startup. And the management team by far is the most heavily weighted, because we'll invest early. We'll invest pre-revenue. We don't have a lot of traction to go off of. So what are we judging? It's the founder. Like, what do we have conviction around the founder and be able, and him or her being able to, create and run a successful startup. And the way that we start to assess that is through the process. And one thing that we're always looking at is, as a founder, you have to get up to speed quickly on a lot of different areas of the business in order to be successful, especially when you might be a solo founder or have a very small team. You're doing a lot of different things. So we're always asking a lot of different questions about different aspects of the business, whether it's related to financial acumen and capital planning and financial projections, or if it's related to hiring, or if it's related to marketing and marketing strategies and marketing costs. And we're asking a lot of different things to one, learn about the business and kind of do our research, but two, we're also kind of gauging the founder on what's their current knowledge on some of these topics and what's their ability to get up to speed on topics and kind of move quickly. So that's kind of the approach that we take. So it's assessing the business and some of the key business metrics, but just as importantly, it's assessing the founder to really kind of try to get a gauge on their capabilities. And then to pivot to your question on traction, yeah, that's an interesting one for us because it's a spectrum there, because we'll go pre-product, we'll go pre-revenue. And say up to a couple 100,000 of ARR. So there's no specific like growth metric that we're looking for when we make our initial investment, because we will go early. But to us, it's more about, to Henry's earlier point, is, what can this look like moving forward? And we're always thinking through, okay, how much capital is needed now to get to a important milestone that will then set up the company for the next round and attract additional investors. And I think that's something that we've seen a lot of, especially in the Midwest and Wisconsin and Minnesota. Our experience is, once you can get traction from a revenue standpoint, and this varies, but say, you can get to 500,000 ARR or something like that, 750, whatever it might be. Once you start to demonstrate that traction, I think the world of capital really opens up, and we start to attract larger VCs that have larger funds that are from Chicago and Indianapolis and Kansas City, and obviously there's larger ones in Minneapolis as well. But you start to kind of open that aperture a little bit. So that's really our focus with founders, is figuring out what's the right round size now that will get you to a place where we can start to attract more capital. So then it's all based on capital plan and the milestones to be able to get there.
That's great. Henry, maybe you could answer the same question about how you evaluate team, but also Daniel had a follow-on question about that. A company with multiple founders, for a company with multiple founders, does that impact how the VCs look at that startup team? So we can talk about team from a general sense, but also multiple founder companies.
Yeah, yeah. I mean, just like Garrett mentioned earlier, we do early stage investment, and I think it's a lot more tough to do due diligence on that kind of, on very early stage deals, right? It's a lot more easier for Series A, B. You have the data, you have the information to analyze and make a decision out of it, but usually tougher for early stage companies. And so you're forced to rely a lot on intuition and, but more importantly, on the founder DNA, right? You use the word that really resonates with me. I see that a lot in engaging with founders as well, is there has to be a founder problem fit, right? We're not talking about product market fit or those good stuff. At these early stages, it's about, is there a good fit between the founder? Is there good knowledge? Does the founder have knowledge of the market? So this is something I really look out for. How knowledgeable are you in the market? And especially for early stage companies and new to the game, maybe perhaps you're up against some strong and heavy competition. Like, you have to be coming to the market with some unique insights, perhaps something your larger competition are neglecting in the market, which you've stumbled across, and you think this could give you an edge in the market. So these are the things I look out for. I look out for, what insight do you have in the market coming into this market? What unique insight do you think would give you an edge in market share, coming into the market, even as a young company, right? So that's a lot of the things I like to look at. And I also like to look at, just to answer Daniel's question. So most times, I mean, the data is out there. When you have startups that is run by 3-4 co-founders, sometimes there is cohesion between the team. There's a good relationship between the team, and sometimes it's not structured in a way that ensures that there's control, in terms of how decision is being made, right? So I think at that point, especially if I'm dealing with companies or startups that have such kind of makeup within the founding team, is about, I'll just keep an eye out for during the entire process, how well are they coordinated? How well do they agree to things? Like, how easy it is to work through differences and arrive at a decision? How is the decision being made? I like to look at those team dynamics to ensure that, hey, there is strong cohesion between the team that can guarantee that. I mean, my problem as a VC after injecting a shit ton of cash into the company won't be, hey, this team might break up one day and then I'll lose my investment and all that. But you're looking for a team that no matter number of people within the team, they're able to understand each other and then agree on how to make decisions moving forward. I think the most important thing I'll point out with regards to Daniel's question would be, it's about ownership. What I would do as a VC would look at the ownership structure, right? You don't want to have a situation where you have 4 co-founders, everyone has the same amount of shares in the company, right? For me, it's not well structured, because you need to come to a structure that allows, there has to be someone that has that. There has to be someone within the team that is tasked with more like deal breaker here, like someone that steps in when they are, in terms of decision making. There's a point where nobody can agree to anything. Like there has to be someone there that has that right, to be able to come in and ensure that things keep moving forward. Because I've seen that sink a lot of companies, even very good companies, just because they don't have a proper structure in place. So I would say structure should be something to take note of, even if it's by 0.5 basis points or whatever it is. Someone has to be a majority stakeholder, just to ensure that decisions are not, going to be a problem moving forward. So that's what I would add to this.
That's a great point, because even high functioning teams aren't going to agree on everything, and if you've got to have 100%. Some evidence or some belief that they're going to be able to make a decision. So that's great. Hey, going back, Carl had asked a question when we were talking about pipeline and evaluating deals down to how many you do around female founders and how that looks, and have you seen any changes there over time? If you could just speak to that a little bit.
Yeah, I can say from the Idea Fund's perspective, Carla, I don't have a good sense of demographics across the pipeline specifically. It's not a metric that I actively track. However, now that you say that, I certainly could. I could speak to, from the investments that we made, if we look at between our Fund 1 and Fund 2 investments and kind of look at those first 15 or 16 or so that we've made, 25% of them are into female-owned startups, meaning women CEOs that have the majority of the stock ownership, and then there's other ones within the portfolio where we have women, co-founders that might be in a COO role or a CTO role or something like that. But if we kind of just think of like women as CEO, I would say about 25% of the deals that we've done thus far between our two funds have been with female CEOs.
Yeah, I think I'll just jump in right now. So for us, I don't think so. I mean, being in the front lines, looking for deals that we invest in at Espat Dojo, it's not really a priority for us in terms of, hey, it has to be like we have a special mandate for. It just happened to be that out of our over 260 investments we've made, more than 41% of those are into female-led companies, right? I would say we're doing a very good job on that front, but at the same time, I want to also point, it's not like something we came out and we say, no, we want to just invest in a significant number of female-led companies. No, it just happened to be after doing so much investments, analyzing that, we found out, hey, over 41% of those investments have gone to female-led startups. And I think it's something very key, because I see the magic that women do when it comes to building businesses, and I respect them a lot for that. And that has also encouraged us to also pay a little bit more attention towards that direction. But I think it brings a unique type of diversity into portfolio construct, and it's something I also find valuable, right? So
that's great. Hey, I'd like to ask one more kind of overarching question for both of you, because you're both Expert Dojo is new at looking into Minnesota market. Idea Fund has been focusing on Minnesota a bit and has an upper Midwest priority. But what do you see in Minnesota? What attracts you to it? What do you hope to get done here? And maybe I'll start with Garrett and Henry. I think you're probably more at an evaluation stage, but I'd like to hear your perspective too on what might interest you about investing in Minnesota.
Yeah, I would say, the thing that I'm most excited about for Idea Fund and being more ingrained in the Minnesota market is just the level of talent. I've had so many great conversations with founders where it's clear to see that the ideas and the talent in Minnesota far outweigh the available capital. And one thing that I'm starting to get more into too, obviously the Twin Cities is the epicenter, right, of startup activity, but it's not the only place. Like, I'm starting to talk to founders throughout the state, which is great. And so that's where I'm most excited is there's so many smart, talented people with great ideas all over Minnesota, and that are willing to go out and take the risk. Like it's a big jump, to go, especially if you're moving out of industry into starting a startup. There's of course pros and cons, but it's a risk. And so just seeing the number of people with not only the talent but the conviction to make that move is really exciting, and we really just hope to be a small part of the ecosystem that supports that. And what I've seen in the whole up Wisconsin and Iowa, this is the same. It's at there's just not enough capital, especially at the early stage. And if there's some great angel investors in Minnesota, and if you can go and raise $50,000 from an individual, that's awesome, and that can really get you started. Where we're really looking to be additive is, to find those companies and founders that fit with our strategy and thesis, that we can really back, say 500K to $1 million, to give it a go. Like that's a good amount of capital infusion for a single or a small team. Like let's really put some capital at an early stage and see where we can take it. And I think that, probably true everywhere, but I think in the upper Midwest, the more funds that are willing to do that is going to be beneficial for the whole ecosystem.
That's great, Garrett. Thank you. Henry, anything?
Yeah, I mean, like you said, we're still in the evaluation process, and Simon is really pushing on that front. But yeah, I mean, what I can say to this would be, so we are targeting over 100 deals this year, and that means really seeing as many deal flow as possible, quality deal flow. And I remember when Simon brought this up, it's about what is happening within the Minnesota ecosystem, and it just piqued our interest, and it would be nice to see the quality of deals coming from the region, and to see how we can further engage them, especially on the growth side of things, because that's what we're known for, not just for the investment, but really helping teams advance growth. And beyond that path to raising a Series A down the line, that's what we care about. That's what we want to see companies achieve, and what we want to help them achieve as well. So yeah, it's an ongoing look, but I think, Garrett, I'll probably connect with you after this. I love the facts that you have some insights into the region, and you've been investing there for some time now. So I would love to reconnect at some point, and then let's see how we can do things together over there.
That's great. Hey, really appreciate that feedback. A couple of points of housekeeping. I did drop the website link for both Expert Dojo and Idea Fund in the chat. Also, a link to the Launch Minnesota Capital website. So we've got a page on our website where you can sort companies that are interested in investing in Minnesota, sortable by stage, by amount, stuff like that. Both of these gentlemen are represented in there. Both their funds are in there, so we appreciate that. And Garrett dropped his email in there as well, and Henry, you're obviously welcome to do it as well. So I'd just like to thank Henry and Garrett both for joining. Appreciate your insight. I think the whole team here, everybody who's either a founder or supports founders, I think has gotten a lot out of your wisdom. So I appreciate that. We love new funds joining our ecosystem, and we look forward to a lot of success with you. So thank you so much. This will be posted on our website, so feel free to share it and get other folks watching, because I think there's a lot of benefit to be gained from your insight. Thank you so much, and thank you all for joining.
Thank you, Robert, for having us. Thank you. It's a pleasure.
Have a great day.
Thank you.
Bye.
Yeah.